Black here next to me. She is the founder of Future Perfect Ventures, a seed stage venture company. You specialize in what? Blockchain, machine learning,
IoT,
interconnectivity,
decentralized connectivity.
Exactly. And you're the only one on this panel, aside from me, who's based in New York.
I believe so.
Yeah. Why Silicon Alley?
Why Silicon Alley? I think there's so much happening here, and it's part of the future. I spent a number of years out on the West Coast with Intel Capital, and I just saw as technology usage proliferates, and we see it's seeping into every element of our daily lives, that there are going to be more and more companies that are founded outside of Silicon Valley that require domain expertise. And New York is certainly a great place for fintech.
Perfect. And some of your investments are like Abra, BitPesa, Blockstream, The Muse, and other early stage rounds. Next to her is Arvind. Arvind is managing director, and he's over at Citi Ventures, overseeing their investments there. Typically, what B stage or later is what you all get into. Some names that you might have heard of, like Betterment or Silence, Tanium. All of these are on my potential deal list, so they're ones that I track closely. And you are based in?
We're based in the San Francisco Bay Area. So we have 2 folks in New York, 6 of us in the Bay Area, and 1 in Israel as well.
Perfect. And Mike, he's a partner at 500 Startups on the Fintech Fund, right? It's you and your partner oversee the Fintech Fund specifically. You have co-founded 6 startups, 2 sold, 1 went public, unfortunately.
One was acquired, and I went to that.
Perfect. And you also, which I think will be interesting as we discuss on this panel, help advise financial institutions on developing startup innovation type cultures, which I do think is interesting as well. Credit Karma is one of your investments. Karma with an M. He caught a spelling error in my notes earlier, so this journalist is ashamed. Also, Grab and Simple, which sold to BBVA, are all past investments of Mike. So first, I wanted to kind of rewind. So I've been covering IPOs here for 2 years. Before that, it was East Coast Tech. And when I was thinking about the fintech startups here 2, 3, 4 years ago, it was all the headlines were, watch out, banks, financial institutions, these startups are coming for you. Now there's a lot of partnering talk going on. I'm curious, and maybe I'll start with you, Mike. When you think of kind of the genesis of global fintech trends that we're talking about today, why have we had this shift from watch your back banks, the startup ecosystem is out to get you, to now let's see how we can all make this work as a kind of global ecosystem?
I think it's just a question of how industries transform generally, right? If you look at media, you look at telecommunications, you look at all these others, they've all followed this pattern where startups show up, they say they're going to break everything, right? And then the fact of the matter is some break everything and others end up partnering with large institutions. So it just took financial services a little while to realize, and it took entrepreneurs working in fintech a little while to realize that this industry was going to follow the same pattern as everyone before.
And break everything, that's a very startup mentality, especially in the seed stage. But fintech is a much more regulated area than a lot of kind of the other verticals within startup investing and company formation. Does that really apply? Does the break everything mentality, that kind of cowboy mentality, does that apply? Are there certain spaces within fintech that you think it's more applicable?
Well, I think that mentality is helpful in terms of thinking of new ways of doing things. Now, the actual implementation, you're dealing with people's money, you're dealing with people's savings. You need to pay attention to security and how you're handling the money. So I feel like we've seen lots of examples of companies from the Valley with that mentality who ended up not making it or running into regulatory issues even after they were larger. And so I think it's very important for anyone in this space, any entrepreneur in this space, to respect where the regulation is and understand it's there for a reason. That doesn't mean they can't move the needle. I mean, there's certain proposals right now to make it easier for fintech companies to get started and have access to data, and that's happened in the UK. And so I think we're moving along, but it's also helping educate the regulators.
And Arvind, when you think about how you are investing in companies, we are talking back in the green room, B stage and on, that's post-product formation, right? They know what they're going to be. It's not just an idea or a management team that you're putting money into. Does this regulatory idea play into that? And I'm thinking about it, you're coming from one of these big banks, you're the venture arm. How does that impact your investment strategy?
Yeah, the Series B stage versus something that's much later on, I think we need to look at it in two different ways. Yes, the answer is, we absolutely look at that aspect of things, because regulatory, just like cybersecurity, is like a very asymmetrical issue, right? One bad situation can actually really derail your track.
We've seen the casualties, public and private.
Exactly. So we do look at that. But at the same time, we realize that a Series B company is not going to have that same infrastructure and process that a much later stage company will have, never mind a big bank like Citi. So we take that into account, and like anything else, we have to assess the team, right? Their ability to operate that, focus on operational excellence, focus on compliance, whether they're, have board members who are asking the right questions at the board meetings. These are all things that we look at because, almost every sector in financial services is regulated.
And I'm curious about this dynamic here, right? You have the financial institutions venture arm with Arvind. You have the startup and the person who kind of comes in and helps perhaps educate from the startup perspective. I guess, Mike, when you think about companies as they are developing, how much conversation do you have with founders, with the teams, about how to work with the big banks?
That feature is very large for us, me in particular, along with my partner. We call it teaching incumbent empathy.
Teaching incumbent empathy.
By our estimation, very few fintech or financial services startups are going to get wherever it is that they want to go without having some relationships with the existing financial ecosystem, whether that's because they're selling portions of their balance sheet or because they need access to payment networks or data or whatever it is. So they need to understand really two things from a very early stage. One is, what does their regulatory roadmap look like? Because the existing financial ecosystem is not going to talk to them if they don't come in with compliance manual. And the other one is how these large organizations work, right? So that at least they don't sort of break themselves on the wall of purchasing process.
And how does it work at Citi? I mean, you are the venture arm. Obviously, M&A is a big part of this world. I would love for it to be more of a part so I could be busier, but we'll get to that in a little bit. Yeah, exactly. Exits are a good thing, I hear, in this business, that real ROI, not just paper ROI. And when you think about your role as a venture arm, are you investing for return? Are you investing to make sure the bank is a customer and that these startups are developing things that you need instead of doing it in-house at Citi? How do you think about Citi Ventures?
Yeah, I mean, I think that we think about both of those things, right? Both financial return as well as strategic impact. But to be clear, we exist because of the strategic nature of what we do. And so to Mike's point, I mean, one of the things we do a lot is stay very close to our businesses, understand their priorities, understand their needs, and play that role of being able to connect the dots of companies that are working in certain spaces that could be interesting, important to our business. And sometimes the vice versa, right? So entrepreneurs, especially tech entrepreneurs, are not familiar with financial services, especially in Silicon Valley. I think in New York, there's a lot more of that knowledge that is out in the ecosystem. But in Silicon Valley, we end up talking to people where, let's say, we're talking to a company that's doing machine learning, and we talk to them about financial services and how, and the role they can play in various aspects.
And would this be a company that didn't already cater to financial services? Or
sometimes they're not, because they're going after other verticals, and sometimes they are, but they don't have large financial customers. And so we play that role of, there's a big impedance mismatch, right? That's the term we use between the way startups move and the way big financials move, and we try to bridge that gap.
So we have teaching incumbent empathy, we have impedance mismatch. One thing that we talked about before that I was really interested in is this idea of innovation theater. Yeah. Will you explain to me what this idea was when it comes to this relationship?
Sure, and all due respect to any innovation heads in the room, we often find that corporations recognize that they need to do something about this startup ecosystem. They want to learn from it, they want to acquire, they want to buy a product or whatever. But normally, right, that starts from a perspective of we need to be more agile at our products and services, and we need to figure out how to change our culture so we can hire the next generation of leaders. Then they go out and they say, well, the tools that we have internally, the ways we partner, we buy, all of these things that we've done for years, they're going to work fine, so let's go find startups.
Do they?
No. And so the innovation theater is the really cool space, and you can wear jeans to work now, and maybe I do, I fund some accelerators, I put some money to work, and then when it comes time for those startups to come into the organization, the line of business owners, compliance, standards, marketing, all the people that actually make the corporation run don't know what to do with it, right? So that's innovation theater until they, dig down and realize they have to build new processes and culture.
And Jalik, when you're working with a machine learning company or an IoT company, something that's not traditionally fintech, but they think, or you are helping advise them to think that they have an opportunity to sell into fintech clients. How do you work with them as a seed stage investor? How do you use your connections and your background?
Well, I define fintech very broadly, because if you look at how many transactions are occurring, it's not just currency transactions, but it's data. And if you look at the machine-to-machine connectivity, they're going to have to communicate and do these data transactions with each other. So to me, fintech is much broader than the way we often define it. And one of the things I've seen is that financial institutions are actually early adopters of a lot of technology, and that they've had these big IT departments, great machine learning data scientists on staff. Post 2008, there was obviously a big change, but we have a lot of folks who are, especially in New York, have expertise from some of these larger banks who are now starting companies or have been over the last few years. So I think it's actually different when I meet an entrepreneur from the Valley, where in New York they usually know they have to hire a compliance person pretty early on. Right after they get seed funded. In the Valley, they just don't have a line item for that compliance.
But that's
person.
been, and it was something that was touched on in the last panel a little bit too. Is it financial tech, or is it tech enabling finance?
Yeah.
I guess, is there a difference? Do you think about that as a difference?
The answer is yes. Right? Financial services is transforming. There's going to be some winners that are new, and there's going to be some winners that provide technology to incumbents to help them modernize.
Do you think, when you think about where your companies could end up landing, whether it's M&A or whether it's as a customer, where do the tech companies come in? The Googles and the Facebooks of the world. We've talked about banks. We've seen it happening in hedge funds and investing, especially in machine learning and some of the algorithmic technology. Facebook, Google, Amazon, Alibaba, where do they play in this ecosystem?
Well, I think Alibaba, and we can get into the conversation of the innovation that's happening outside of the U.S. Versus the U.S. I'd argue that a lot of the really innovative approaches to financial services are happening outside of the U.S. just because they're not the legacy infrastructures or no credit cards. We know the statistics of 2 billion unbanked people in the world, 1.5 billion people around the world without any form of identity, which doesn't give them access to credit. And so if you look at Alibaba, they kind of fuse the financial services and the social networking and the e-commerce into one. You look at WeChat and the peer-to-peer payments that they've enabled. It's a completely seamless experience. Whereas here, I'm still opening up different apps to do different things. And so I think we're in a lot of ways more behind, but we're also we've had financial services for much longer than most of the rest of the world.
And opening apps to do different things. How many of y'all use more than 4 applications a day on your phone? How many? I expected more hand. I expected every hand. More than 10?
Oh, maybe.
All right, let's narrow the pool a little bit for financial-based things, buying items, banking, checking your how much credit you have on your card. How many use more than 3 applications? Is this worrying to a bank right? If like, are you this platform idea where it's all in one hasn't really permeated here? Is this something that's on the mind in the nightmares of the folks on the Citi side of things?
Well, I think we talked a little bit earlier, right? I mean, I think that just as the startups have basically said, look, we need to partner with the big banks, I think the banks woke up and also said, well, there's something happening here. Let's understand what's happening and let's start to think about how we bring some of that in. So part of what we do is to bring that outside in, right? And we think a lot about the trends that are happening in the startup ecosystem and then inform our businesses and work with our businesses on how to think about their roadmaps and so on. In terms of the multiple apps and sort of the best of breed type of thing, look, I think that that's never really going to go away, right? We already have multiple bank accounts. We have brokerage accounts, and those have been around for decades, and they have not all magically combined into one account. And so I think that the multiple account scenario and the multiple app scenario will exist for a long period of time. And so to support that, for example, one of our investments is a company called Plaid, right? And so they're kind of building that connectivity layer so that it becomes easier for people to aggregate their accounts, to connect one account to another so they can move money and do things of that nature. And I think that there is a real need for that kind of connectivity because nobody can regulate or centralize and say, well, there shall be one account, right? If people are always going to innovate, startups are going to innovate, and people will flock to those services, and that's the environment we live in.
And Dalek, when you think about, I did think in terms of the innovation factor, these places that do have a large unbanked population where they're having to be really creative in terms of how they are enabling consumers to access financial things, period. Where are you seeing some of the most interesting investment? I mean, you had a background in emerging markets investing as well. Are there places that you think there are technologies that are applicable here?
Yeah, and I wrote a blog post 3 or 4 years ago called "When Third is First," when we're starting to see innovation in these emerging markets start to come to the U.S., where for many years it was the other way around. So M-Pesa in Nairobi is an example a lot of people use. I was born in Nairobi. I first used M-Pesa in 2008, right after it was released. And I remember having someone teach me on a feature phone how to send money, and they just thought it was the funniest thing that I came from the United States, and we didn't have anything like that I was so fascinated by this technology where I could just transfer money.
Now everyone's building their own,
right,
all the banks, Venmo, et cetera.
And then I think India is really fascinating right now because they have something called the India Stack. And they are building a KYC database. They're offering a lot of services that just from the ground up that we're kind of piecing together in the developed world. So I think India is certainly a place to watch. And if you look at the statistics, India and China, the two most populous countries, they have the largest percentage of people who don't use traditional financial services. So I'm always tracking what's happening in these different regions. And I was an early investor in the blockchain space. And the reason I got interested in it was the connectivity and the transparency that could enable, like opening up an M-Pesa for across borders. And that was what first engaged me 4 years ago.
And Mike, you seem to be nodding at some of the India mentions as well. I am interested, though. It seemed like when we were back there, even with the earlier panelists, you all know each other. It is a small space, right? It's a small world. I'm sure you in the audience know some of the folks who are sitting around you as well. Because it is so insular, and you seem to know the names that are bubbling up and coming up. As an early stage investor, how do you pick the right winners? How do you pick the winners that not everyone's flocking to? Can you give us a little taste of the secret sauce?
Well, 500 startups, right, actually has 2,000 startups in our portfolio, and we operate a little differently than most VCs in that we play large portfolio theory. So we don't actually attempt to pick winners because we can make enough bets and be close to those companies as they evolve. So I'm relieved from that particular pressure. That said, we do look for entrepreneurs that demonstrate certain personal characteristics, basically they get up out of bed every morning and want to change the world in some way, and then some capability of execution, whether that's on the technical side, whether that's having the maturity to go look at what their regulatory roadmap may be early. And then we look for white space, right? If you think about the unicorns that are out there, there's a ton of them in payments. There's a ton of, and this globally, there's a ton of them in lending. You start to look at insurance or capital markets or other areas of financial services, it's still white space for the most part.
And RegTech is something that I feel like all three of y'all brought up. I mean, Arvind, is this something that you are looking at, this RegTech space? Break this down for me.
Yeah, absolutely. I mean, I think, not a fan of the term itself. But
That's
I think
right. No one likes regulation, right?
But I think for people who've been within banks, I mean, you know how complicated, large banks, you know how complicated it is to actually manage the infrastructure that regulates, it makes sure that we're all compliant to the regulations that are out there, and there's so many regulations as well. So I think the application of technology, so what happens typically is you end up having some technology but a lot of manual processes, right? And so it's an area that people have recognized within financial services that you can apply technology and not only save a lot in cost, make it more efficient, but certainly also actually make our compliance even better, right? And so the things that have happened in the technology stack, whether it's big data and the Hadoop stack, or things that are happening at the upper layer, artificial intelligence, machine learning, that type of stuff, I think that they have a role to play in regulations. It's not just machine learning; it's all kinds of technologies that can be applied to regulations to make sure that we're better compliant. And so we're looking at that space. We have investments currently that are in big data or analytics that are being applied to the regulatory space. But I think there are plenty of problems to be solved, right? From the point of view of the entrepreneur, I think that the regulatory area within financial services actually has huge market opportunities. And I think it's when you have a situation where you're solving problems that exist today, that's when it's easiest to do market entry. And so I think it's a rich area.
So for maybe the non-C-suite, the Fintech folks in the room, RegTech, that's your opportunity. The last few minutes here, I want to touch on something that is close to my heart because it is anti-regulation and kind of the opposite side of the coin, no pun intended, of what I cover every day, which is IPOs. And I know it's kind of your sweet spot. I know you did hear a little bit about it, but I wanted to just see what you all think of investors of initial coin offerings. It's something that's been, frankly, in the news quite a bit these days. I've never seen an IPO sell in 12 minutes. Even if it's only $35 million, the roadshow process still goes on for about a week beforehand. But initial coin offerings, I mean, you've played in Bitcoin a lot. Is that something, we'll start here, is that something that you would invest in, is an ICO of a potential portfolio company?
Well, I have several portfolio companies right now who are planning initial coin offerings. It's a wild west. I started my investment career in the mid-'90s, and it reminds me of the early days of the internet. I think there's going to be something really lasting out of this, but I think there are going to be a lot of casualties in the process because everyone's just trying to go, just like everyone was trying to go public in the late 90s, people are just trying to do these ICOs, and it's unclear whether they actually have real technology behind it or it's just a quick way to make money and take advantage of the momentum. I personally do have some investments outside of Ethereum and Bitcoin, but the fund just this more traditional venture investing, but that may change in the coming months.
And that dichotomy between your personal conviction in it and the more traditional venture investing seems to be important when it comes to these, frankly, no regulation raisings of capital. Is this something that either of you would consider investing in? I'll go to you first, Mike.
So the real answer is I don't know. What fascinates me about them is, one of the hardest things for an early stage company to do is acquire customers, is to activate, the entrepreneur's community. And the idea of that being a tool, right, an ICO being a tool to truly get their community engaged is pretty interesting to me. Whether as early as we invest, we feel like there's for some of these companies, right, business, right, going back to the 90s. Business plan, let's do a blank PO. I'm a little concerned.
And correct me if I'm wrong, the initial coin offerings, they're basically selling tokens that you can use on their platforms. Like Mozilla was applicable to their ad platform. It is, to your point, kind of back to the business, not necessarily just a capital raise. You're not getting a share of the profit.
It's a combination. I mean,
Right.
a company, I broke it down into 3 categories, and certainly the tokens related to the business are one element of it, but there are other companies that are just creating tokens to be able to raise capital quickly. So it is really the Wild West. So you really require, you really need to dig in and see what you're really going to own. And there are lockups too, because it would be really dangerous for some of these companies if there was immediate liquidity or lack of liquidity. Yep. And so even all of those terms are up in the air right now.
Arvin, a lot of question marks here, obviously. Is that something that you would feel like you need to justify fighting for that kind of investment to Citi? I feel like this would be a fight if you wanted to get in.
You'd be right. No, I think it's too early, and I think just as a group, given our mission, we've tried to look at areas where there is actually direct applicability to our business, and so we haven't done any of the crypto coin currency kind of investments. We're investors in chain, which enables people to build blockchains. And we recently announced with NASDAQ, exactly, with the NASDAQ, an application of chains technology. And so I think we're playing there, but not ready yet to go into this area.
So thank you all for joining us. If my takeaways are right, ICO's Wild Wild West, not going to put the IPO reporter out of business just yet. Avoid innovation theater, and if you're looking to get into something, RegTech seems like a place where at least some firms have some need. Thank you, everyone, for joining us, and thanks for joining us tonight.